Hello, everyone, and welcome to today's webinar. So great to have you all here, whether you're catching it live or the recording afterwards. We're going to be talking about unlocking NUA, or net unrealized appreciation, and smart post-retirement moves. So cool things you can do with the NUA shares after you roll it over. Just to kind of kick off, so my name is Morgan Veth. I am a certified financial planner. I've been at Bogart for over 3 years, but in the industry for 20. So love what I do and really helping families to identify and achieve their financial goals. Quick bit about Bogart. If you are new here, we were formally founded in 2016. We have 3 offices, so in McLean, Virginia, where I'm sitting now, and then 2 offices in Texas as well. We currently support over 1,400 families, 50 plus employees. I think that's doubled in the short time I've been here. I don't know. It's been quite a bit of growth. And the current assets that we advise our clients on and we have under management is $3.1 billion. So here's our agenda for today on net unrealized appreciation. I will shorten it and say NUA throughout a lot of the presentation. I'm from Mississippi, so I draw it out to like 12 syllables. It's better for all of us if I just shorten it. But we'll talk about, again, some post-retirement strategies, estate planning, taxes, and cash flow, just different considerations and cool things you can do with NUA shares. We'll also talk about good till canceled orders and covered calls. There's also a chat box open. I will try to get through as many as I can, but feel free to pop me in a question if you have one as we go along. Otherwise, let's dive in. So let's first kind of break it down and talk about 2 big categories of assets or investments, and that is qualified and non-qualified. And so for any of our clients where we've done a financial plan, you've seen in that financial plan, we do your net worth as part of it. And those are 2 big categories, qualified, non-qualified. So a qualified plan is like a 401k. That's the most common one. And so, the good part about a 401k is, your salaries contributed on a pre-tax basis. There are other ways you can contribute, but generally speaking, and the most kind of basic way and option everyone has is pre-tax. So coming out before it's even subject to any taxes in your payroll. And so you save taxes every single year while whatever goes into the 401k, it is taxed later. Pay no taxes on gains or dividends or interest. So qualified account, your 401k is a tax-sheltered account. If you trade in it, you're not generating a capital gain. Any of the growth in there, not subject to taxes in that year. It's taxed on the way out. Another big benefit of a 401k, and really why they became so popular, is for most people, you get a company match, myself included. So as pensions, slowly started to go away, this was introduced as a way to incentivize employees to save for their retirement. So you get free money by way of your company match. The not so good part are the other considerations. Of course, the IRS doesn't say, oh yeah, here's all the good stuff, put it in, without some caveats and exceptions or things to consider. So within a 401k, there is a 10% tax penalty if you take it out before age 59 and a half. Some exceptions to that, but generally speaking, it's for retirement. If you withdraw before that, you've got your ordinary income tax and a 10% penalty on top of it. Every dollar is taxed at ordinary income rates. So what you put in and all the growth or appreciation, when it comes out, it is subject to ordinary income rates at that time. So whatever is applicable to you, that's the tax that you pay. You promise to take every dollar out during retirement. Kind of. So there are required distributions, which is what we're referencing here. And there's an actuarial table. I don't think it gets to 100% withdrawal until like age 120. But the point being, you can't just put the money in, let it grow tax-free or tax-sheltered for decades upon end. There is a point for some at 73, some at 75, where you have required minimum distributions. So we calculate for you. The IRS says, here's the table. We calculate to tell you, here's what you have to take out and pay tax on each year. There is also a pretty big penalty for failure if you don't take your required minimum distributions that I just referenced. The Secure Act did lighten it up a little bit. It was 50%, and it's now moved down to 25% with an opportunity to get it even lower. But either way, you don't want to miss those required distributions. Doesn't make the IRS happy. And it's just kind of a pain for you to deal with. Your custodian's obligated to tell the government, no, we don't go tattle on you every year, but there are tax forms, 1099-R and 5498, that are generated to show, if there is a required distribution and if it was taken or not. So that's what that bullet point's referencing. Non-qualified account. So again, two big categories. Talked about the qualified. What's a non-qualified account? It's your non-retirement brokerage account, savings account, cash, anything. It's an after-tax account that you can invest in. All investments are on an after-tax basis, so you pay taxes throughout the year. So if you get a dividend, even if you have it automatically reinvested and you don't necessarily withdraw it, you still pay tax on it. There's still a form generated whether you withdraw or reinvest. You pay taxes on capital gains. I mentioned earlier, you can go trade in your 401k. Not going to cause any kind of a capital gain or tax situation. If you do that exact same trade on an appreciated position in your non-qualified brokerage account, you will pay capital gains or be subject to them in that year. And you don't get a company match. So far, I haven't seen any incentives or offers for a company to match into a non-qualified account. The good thing about it, though, so there's no early withdrawal. You don't have a 10% penalty. You can take it out whenever you want it. There's really no restrictions around that. So this is really for that, interim money that you need or something you might want just outside of retirement. You aren't forced to take it out. So you can take it out whenever you want, and you don't have to take it out unless you want. There's no RMDs. And as I mentioned, you can, if you place a trade and realize some gains, yes, you pay taxes, but the capital gains tax rates are much more favorable than ordinary income rates for most people. And we'll dive into that a little bit later as well. So let's talk about NUAs. We've talked about the two different types of accounts to kind of set up as it involves those two different types of accounts. It's kind of like a do-over is really the best way to put it. So you've got these shares in your qualified plan or 401k, and NUA is this one-time opportunity to be able to pull them out into a non-qualified account. Again, for tax reasons that we'll dive into. The caveats. So NUA is not available to everyone. Number one, it only applies to your employer's stock. So if you can buy your employer stock within your savings plan or 401k, it can include company match. So it doesn't matter the source of the shares that are purchased in the plan. You can be very specific about the shares that you want to declare NUA on. It must be part of a lump sum distribution. So in the year that you do NUA, your balance in that 401k better be zero by the end of the year. Can't just cherry pick those shares out. And then there's got to be a qualifying event. This names a few of them. If you separate after service after age 55, hitting 59 and a half, disability, or the one we don't want to be a trigger, but death. So if you didn't ever roll your money out of your savings plan, still have those company shares in there, and you pass away, your beneficiaries of that plan still have a chance. NUA's back on the table. And yeah, again, must remove everything from the 401k and roll it over. So why is it called NUA? So if you think about net unrealized appreciation, if you kind of break it down, it makes sense. I mean, net is just saying, what's the difference? So we're talking about the current stock value. Where is this company stock trading today? Minus your cost basis. What did you pay for it in the plan? And again, that's record kept. So net, the difference in those two, unrealized because you haven't sold the shares yet. So technically a gain is just paper gain until you actually sell the position and lock it in. So unrealized appreciation. It's gone up in value. It's appreciated. Again, it's a tax optimization is really the main reason that you would do it. And again, it's specific to employer stock. The lower the cost basis, the better. And the higher that stock is currently trading, the better. So hard to time it exactly. NUA can make sense for a lot of people at a lot of different times. But these are some scenarios where it becomes really, really compelling to utilize NUA. So for tax treatment, and we're going to apply some numbers to this. I'm more visual in that way in a minute. I think it'll be helpful. But for the NUA shares, so let's say the dark blue box, here's your shares. If you leave them in the plan, if you don't do NUA, whatever the value is, taxed at ordinary income rates when it comes out, dollar for dollar. And that's whether you leave it in the 401k or if you rolled everything to an IRA, didn't utilize NUA, but just moved all of your shares over to an IRA, same thing. You're going to be taxed at ordinary income rates when you withdraw from that 401k or IRA. But for NUA on the right, so the basis is taxed at ordinary income rates. And then the gain, so the net unrealized appreciation, is taxed when sold at the more favorable capital gains rates. So here's just a breakdown of, ordinary income rates as they currently are versus capital gains rates. So the vast majority of people are at the 15% rate. There's sometimes we can utilize that 0%. I love doing that. There's, some that can be subject to the 0% depending on your income situation. And then if your income's high enough, the capital gains above a certain threshold tip to the 20%. The 3.8 you see here, so that's the Obama surtax or net investment income tax, right, of 3.8%. NUA is actually, the gains on that is not subject to the additional 3.8% tax. Everything else in the investment world is, but just so that's why it's listed here. But again, for NUA shares, the appreciation when you sell those, that portion is not subject to the additional 3.8% tax, which is another nice benefit. So this is just putting in some numbers for the slides that I showed up above a bit. So again, in this example, there's 500,000 of company stock, and you can either leave it in or roll it, right? Don't do NUA, and you're going to have ordinary income. Or in this example, that same 500,000 is made up of stock that has a cost basis of 100,000. So that's what would be taxed at ordinary income rates, the gains at long-term capital gains. So when you do NUA, the savings, so this shows savings plan or a 401k. The shares that you declare NUA on and move out, they move in kind. You stay invested while they're moving over into a brokerage or non-qualified account. And then everything else has to come out of the plan. So anything else, other mutual funds or there's shares in there you don't declare NUA on, those all roll over to an individual retirement account. So this is kind of a breakdown. If you've ever done an NUA analysis, if we've ever provided one, this is going to look pretty familiar, but it just shows you the way it all flows. And again, when we do an analysis for our clients who are considering NUA, obviously we get a statement and put your exact numbers in here. So it's customized to you. But you've got your 401k. And then you take the shares that you declare NUA on in kind. So those come over to a brokerage account. If there's, again, other shares in there that you want to keep in kind but don't want to declare NUA on, you can keep those in kind as well or sell them. It's up to you. And then everything else pre-tax goes to an IRA. They're going to send one big check for that amount. It isn't taxable. but they do send a check. And then if you do have any Roth portion in your 401k, so Roth has now been around for a little bit, and most plans offer it now. I think they have to. So if there's any Roth money in there, then that separately goes to a Roth IRA. So just applying some figures to that. So same kind of flow here, but here's the example. So the employer stock's currently trading at $100 per share. We want to declare NUA on 5,000 shares. So there's that 500,000 going to the brokerage account. There's some other shares in there that this person wants to keep. So there's those 500 shares going to an IRA. If you didn't have any additional shares that you wanted to keep, it would just be all the cash going to the IRA. And then if there's Roth portion, to the Roth. So let's break it down. So in that example, this is just continuing on what we just saw above. So the cost basis in this example is $29.50 per share. And the number of shares, 5,000. So just multiplication there. So 147,500 is the total cost basis. The tax paid portion. So this is also something that is not across the board. So not all plans offer post-tax contributions, not Roth, but something completely separate. And this example, and a lot of the savings plans we see, they do offer it. So tax paid is, while this individual was working, they put money in above and beyond their pre-tax limit. They said, I want to keep putting money into the plan. Plan's going to record keep that. You're not going to pay tax on it twice. And so in this example, over their entire career, the person has put in tax paid of $130,916. So when you retire, you have a couple of options with it when you roll it over, if you will. The tax paid, what we usually recommend is that it is applied to the cost basis. So if we're doing NUA, we can say, hey, there's that cost basis is 147, right? That's subject to ordinary income taxes. But I've got money here that I already paid tax on. So I'm going to just apply that and cover, in this case, quite a bit of the cost basis. So the difference or taxable portion there of $16,584 is just cost basis minus the tax paid. We're assuming a healthy tax rate on this, so including some federal and state tax, 40% is the rate. So 40% of the $16,584, that's your tax bill, $6,634 in this scenario. Oh, I got a question here. Do the NUA shares have to roll? So the NUA shares do have to roll into a non-qualified account. Yes, you can roll the shares into an IRA, but if you do that, you're not doing NUA. You're just doing a rollover. So rolling money out of a plan, even if NUA is an option, you've got this company stock and it's available to you, you don't have to do it. Again, I haven't seen many scenarios where it wouldn't make sense, but you can roll the shares to an IRA, but again, then it's not NUA. I got another good question. So what do you do with the tax paid basis of 130? So here the tax paid portion, the 130,916. So the way that would work is it's basically applied to it is the best way to think about it. So with the tax paid, your choices could be when this person goes to rollover, they could have said, I already paid tax on this money. Hey, plan sponsor, my savings plan, just cut me a check for $130,000 and just take it out. You can also take that same basis and you can roll it to a Roth IRA where it's now growing tax-free. Or you can apply it to your cost basis. So another way to think about it for this tax paid, if it was not applied to the cost basis, then the numbers here would be 40% times the 147,500. And in that case, if somebody said, nope, I don't want to apply it, then you'd be rolling it to a Roth IRA. But otherwise, yes, it is just part of, if you declare NUA and apply it, it is in that brokerage account. It's accounted for in your cost basis that we keep on file for you. I hope that answers it. If it doesn't, follow up with us. I got another one. So can you use non-stock tax paid funds to offset? Yes. Yeah, absolutely. I mean, your tax paid is your tax paid. So that's just a source within the plan. So think about your savings plan. You have investments, shares, mutual funds, right? Common assets. So depending, you've got lots of different investment options within it. But then you've also got your sources. So money put in pre-tax, company match, tax paid, so post-tax money that you put in. And they'll all be invested kind of pro rata, right? So when you go to do NUA, your tax paid is your tax paid. It doesn't matter if it was tax paid within a fund, if you will. It's just using that entire source for the plan. Okay. So continuing on with the example. So again, there were 5,000 shares. It's trading at 100. So 500,000 is the value coming out as NUA. Here's your taxable cost basis. So those 5,000 shares, add them up over the years. You've bought them at a variety of different prices, and that's 147,500. So your capital gain, so when they go into the brokerage account, if you say, let's sell right away, let's sell all 5,000, then your NUA capital gain, just the difference in those two, is 352,500. If you sell them right away, or whenever you sell them, that's when you do have a capital gain. And again, in this scenario, we assume what's applicable to most is 15%. So 15% of that capital gain, which is 52,875. Net proceeds. So let's kind of look at it all together because there were two taxable events here. So you've got your 500,000, the value, tax paid on the cost basis. So that's the 40% that wasn't covered by your tax paid. So you've got that. And then the capital gains tax because you sold the shares. So what you net from this total transaction is a little over 440,000. So the net proceeds, if you didn't do NUA, right? So that's with NUA using these examples. If you did not do NUA and you just kept the money in plan or rolled it all over to an IRA, then the 500,000, if you pull that all out in 1 year, whenever that comes out, assuming again that 40% total tax rate between federal and state, 200,000. So your net proceeds are 300,000. So you can see there a pretty substantial difference, right? Over 140,000 tax savings by doing NUA. And this again is, it's applicable to you what tax rate you're at, and we'd go through it specifically. But this is a pretty common scenario, and this is exactly why we would recommend it because now you've saved over 140,000. So the difference here, the two, I should have moved to the slide while I was chatting. But proceeds with NUA, without, there's your benefit. That's real save money. Factors favoring more NUA. So when would you maybe declare more shares or not, or be more inclined to do it? So if the company share price is expected to rise in the future, plans if you want to use the NUA sooner. So we often have a lot of clients who will use these NUA shares to bridge them if they retire before 59 and a half. Then you're able to use that because, again, non-qualified brokerage account, take it out whatever age you want. And another really big factor is expect excess RMD issues later. So I'm going to guess if you are listening to this and you're still working, and if you don't work with a financial advisor or us, you probably have not really kind of put pen to paper to say, you know what, in 20 years, what is my required minimum distribution going to be? We do. So that is very much part of our financial planning that we do, is to forecast, right, based on total expenses, income. So we're looking at the total picture of that. But one part of it is, what do you need to withdraw in those years, right, 75 and after? And what do we expect your required minimum distribution to be? If there is a delta there and you need to take out 100,000 and your required distribution's 150, you've got an RMD problem, so to speak, right? It is forecast to be more than you need. So now you're taking out more and more each year at ordinary income rates. So another reason that factors in, or reason we'd want to do NUA. Factors favoring less NUA. If company share price is expected to fall, I would guess if you're expecting your company's stock to fall or the stock to fall, you probably wouldn't want to own it, period. But yeah, also something to think about. Or I would say just a more reason to do the NUA and then just sell the shares right away. Probably be a better way to think about it. No plan to sell the NUA shares. So if you're never going to sell them, it doesn't make sense. Not typically. Because the real benefit of doing it is to have that tax differential, right? And if you're going to pull the shares out, but not going to sell to take advantage of the capital gains rates, aside from having an RMD issue, there still could be reasons. But aside from that, it might make sense to do less anyway in terms of shares. Or preference for after-tax contributions to flow to the Roth. So again, an option for that tax paid, and this, again, this is specific to some people. This is not a broad characteristic for everyone, because if you don't have tax paid or after-tax money, not applicable. But if you didn't want to apply that tax paid to your cost basis and wanted it to flow over to the Roth, that could be a consideration. So just kind of summarizing here the advantages and disadvantages, although I'm going to just go over because I'm getting a lot of questions. I think one I just answered for you. If I don't plan to sell after retirement, should I still choose NUA? Maybe not, or maybe less shares. Again, that's why we'd like to see if it could still make sense from a RMD perspective, right? Even if you're going to hold those shares, the NUA means less required distribution. So I don't want to give you a hard no. Everyone's different. We would love to run a plan for you and tell you more specifically the answer to that. Where does the post-tax money go? It depends on, so I think I'm going to assume this person is asking in the scenario where we applied it to the cost basis and to the NUA, then that post-tax money is residing in the brokerage account. We're accounting for it there. This is a great question. When you declare NUA and move the stock to an after-tax account, right, to that brokerage account, can you spread out the final sale of the stock so you don't have to book all the capital gains in 1 year or in the first year? Absolutely. When the shares go into, we show you the example just to give you kind of an apples to apples comparison. So in that where I showed, hey, you sell it in this year, here's the capital gains. You do not have to sell, any of your NUA shares, but you certainly don't have to sell them all in 1 year. Once they're in that brokerage account, you could sell them over a number of years. You could use them for your charitable gifting. You could use it to do planned gifts in kind to your kids. Short answer, but great question. You do not have to sell it all in 1 year. If you want to put it over multiple tax years, you can do that. I don't know that I understand that one. But I'll read it because I think it might be a good talking point. So it says, could negative cost basis, so let's say the current share price is $100, but the cost basis was $150. So you paid $150 some point down the line for this stock. Well, today it's trading at $100. And it says, can the shares be used to offset the cost basis? So I don't know what that's asking exactly, but what I will say is if the current stock price is $100 and your cost basis was $150, I would not recommend utilizing NUA at all. So really where it's beneficial is when it's trading above what you paid for it. So again, I don't know that I'm quite answering that, but I wouldn't, if it's trading lower than what you paid for it. Because think about it this way. Let's use that same example and say it's currently trading at 100, but your cost basis is 150. Well, if you do NUA, you are going to pay ordinary income on the cost basis, right, which is 150 times the number of shares. So you're paying tax on a higher number than it's even valued at today. So it wouldn't be a good time to do anyway. You want the current stock price to be higher than the cost basis. Okay. Good. So advantages and disadvantages, just to kind of summarize here. How am I doing on time? Good. So taxed at long-term capital gains rate, not subject to RMDs. You have no early withdrawal penalty. It's all very liquid, and can offset tax cost basis with tax paid. Again, that's kind of one little of a caveat. Disadvantages, cost basis taxed at ordinary income rate. So, in the example where we showed, $500,000 if you didn't do NUA and you take it out, well, you might not be planning to withdraw that for a bit. So, that $500,000, while yes, it is subject to ordinary income taxes, doesn't mean it would be in that year. So that's something to think about. No benefit of tax deferred growth. Again, once it goes into the brokerage account, now the dividends it pays you, or if you reinvest the capital gains, right, it's all taxed in that year. Significant amount of employer stock leads to less diversified portfolio, and dividends taxed at your rate annually. So here we'll talk about contributions that you can make to the plan, right? Pre-tax versus after-tax. So something to think about if you are still working and NUA is something that could be applicable to you, then this is a good kind of call to action, right? So think about your pre-tax versus your after-tax. If you can make after-tax, right, what does that look like? If you can afford to save or defer more, right? Talk with your advisor if that makes sense. Review the NUA cost base versus the tax paid. So just in terms of looking at an NUA analysis, right, and forecasting that. Save more. I wouldn't be a financial advisor, I guess, if we didn't tell you to save more. It's always a good thing. And then just kind of be careful before selling low basis shares. I will say within most of the plans, each plan can be different, but most of the plans that we work with and I'm familiar with, let's say if you did go to sell some shares because you just want to diversify, maybe you're a number of years out for retirement. So do you want to bank on NUA? Who knows where the shares are trading then, right? So you're like, maybe I want to lock some in now. Most plans default to sell the highest cost basis shares, which is a good thing. You'd always want to sell from the highest basis shares if you're just trading within your 401k and kind of preserving those low basis ones for later. So post-retirement strategies, we'll go over estate planning, cash flow, taxes, good till canceled orders, and covered calls. So for estate planning strategies, or just things to think about for those that, quite a few questions. What if I don't want to sell them? You don't have to. So if you declare an NUA, put the shares in a brokerage account, but you just hold on to them. You never need them. You just keep them invested. Pass away and still have those same shares. For your beneficiaries of that specific account, they will pay long-term capital gains on the NUA portion, and then they'll get a step up. And the next slide will make more sense. I know that's kind of a bit of a confusing, but if it's not NUA stock, so if you pass away, any non-NUA stock you hold, then your beneficiaries get a step up in cost basis. So all the gains kind of wiped out, if you will. Their new cost basis is now the value of that stock trading the day you died. NUA is just a little bit different with that. So in this example, we'll say the NUA shares were $400,000 when you die. The stock's worth $750. You never sold it. Good for you. Went up to $750. The cost basis is $100,000. So this kind of shows it better in my opinion. So for the give me a second. Oh, no, I'll leave it here. Sorry. So I thought it broke it out a little bit more, but the cost base is $100,000. Long-term capital gains apply to the original NUA value, right? So it's $500,000. You pulled out $400,000, and then you do get a step up in cost basis on the shares that were above that. So just a little kind of quirk with it, but again, it can still be very tax advantaged to pass along as part of your estate. For cash flow planning, so I mentioned this earlier, but you can use the NUA shares for anything. But it is really common that if we have someone retiring before age 59 and a half, that they will take advantage of NUA and use the proceeds, take it out, sell the shares, and use that to bridge them until they are eligible to pull from retirement accounts without a penalty. There is a rule of 55. So another strategy or option that you have is that if you retire from your employer between 55 and 59 and a half, very specifically, and you leave that money in your 401k, not rolling it over, we're not doing NUA, the IRS does allow you to withdraw money from that one 401k without the 10% early withdrawal penalty. So it's called the rule of 55. I will say a lot of plans limit your withdrawal, so it's just something to be careful around, but it's a great little loophole, if you will, for someone looking to retire early to consider doing that or NUA. But NUA aside, if you don't have company stock, this isn't plan specific, anyone can use rule of 55. So let's kind of move on. And this is just talking about, I could probably spend a lot of time on here, but for the sake of time, I'll probably kind of graze over this one, but just talks about the different sources of cash flow, right, that you have in retirement. So considerations for minimizing your taxes, as taxes are probably your largest expense in retirement that no one thinks about. Healthcare's up there. A lot of expenses to have throughout retirement, but taxes are one of them, while we're always trying to notch those down as low as we can. But holding assets that generate income in a qualified account. So dividends, capital gains, anything that has a high turnover rate, well, maybe that's a position I'd rather have in my IRA versus my brokerage account. Taking distributions from different types of assets. So this is a big thing we also help our clients with. You've got enough to retire. Here we are. We're at retirement. Okay, where do I draw from? So kind of diversifying where you pull it from, as most people have pre-tax money, after-tax money, or right non-qualified, and then tax-free with your Roth. So thinking about what's the right best place to draw from in any given year, as it will generally change from year to year. Withdrawing qualified assets, again, to kind of reduce those future RMDs. And yeah. So again, this is just showing the long-term capital gains rate. So I showed it a couple of slides up, right? 0, 15, and 20. And so this just kind of breaks it down into those specific numbers. One thing to note about this is that if your capital gains tip into a higher bracket, that doesn't mean all of your capital gains are now subjected to that higher rate. And it's a really common question. It's a great question I get. But let's say you're married filing jointly. You have no other sources of ordinary income. You're retired. You're living off post-tax money, right? And you take on capital gains in that year of $200,000. So in that example, the first $98,900, tax-free. No 0% tax on those capital gains. But for the $200,000 minus that, right? So roughly $100,000, we'll call it, anything above that, that is subject to the 15% capital gains rate. So just a breakdown of those. Good till canceled orders. So this is something that did I skip one note? This is really essentially a limit order where you can set a target price that you would like to sell a stock at. So if you leave your shares in your savings plan, you can't target what price you want to sell, right? You can call and make a trade, right? Or go online and say, I want to sell some shares, but you're just usually going to get, what did it average out? What did it close at that day or the next day? And there's a lot that can happen intraday where you want to take advantage of a specific price. So another really big benefit of having shares in a brokerage account or a personal retirement account is that we very frequently will set an order to say, hey, trade X amount of shares of this stock if it hits 125. And now you don't have to be monitoring it, right? Every day, every second. We've certainly seen days where a stock will touch a price just some point throughout the day and then pull right back down. It can be very brief. And so essentially impossible to kind of manually monitor and execute that trade at that exact second. So that's where a good till cancel order, a limit order is a beautiful thing. You can set the price and off it goes. Now it's just automated for you. Covered call strategies is another tactic, something we have in our tool belt that we use. You can use covered call strategies with any stock, but we most commonly do use it when our clients have utilized NUA. Maybe they want to hold on to some of the shares but generate a little bit more income and sell it at a set price. So a covered call is when you essentially sell a call to, it's making a contract with whoever the buyer is. They will pay you a premium to have the ability to buy your stock at a set price. So where that would most commonly happen is, let's say my stock's trading at $100 that I have. Someone will give you money, so you get a premium, right? You make income off of it, and you give someone the right to buy however many shares. You get to dictate 100 shares if it goes up to 110, for example. If the stock never goes above 110, you kept your premium. You just made a little extra income, right? Think like an extra dividend bonus, if you will. If it goes above the strike price, so let's say the stock's now trading at 120. Well, whoever has the right to buy it at 110, they're quite happy, right? So, you do have to be willing to sell it, right? When you're doing that covered call, that's what you're agreeing to. You can buy them back, and there's other caveats, but just at the most kind of basic level of a covered call, it's essentially a contract. You get the premium with a promise to sell at a set price, a number of shares. So yeah, here's just some of the terminology. So strike price, that's that promise price. Like I said, 110, right, was my example. Here's the time frame. They do expire. So, okay, you have the option to buy it for 3 months, 6 months. It is an indefinite time. The premium, again, is the additional cash you make if you sell that covered call. And then you've got whatever underlying stock. You hold the stock that you are selling this option on. Let me pause. I've got a lot of questions. If you use tax paid in a Roth instead of applying to NUA, what would the tax effect be? Great question. So if you use the tax paid, so in that earlier example, I won't make y'all dizzy and go back to it, but the earlier example, the basis was, I think, 147, let's call it. So if that person said, I want to take all of my tax paid and roll it over to a Roth, which you can certainly do, then the 40% in that example, ordinary income tax rate would apply to the full cost basis, the full 147. So if you want to go to a Roth, you can do that. You're just going to have a bigger tax bill in that 1 year on the cost basis. Could you sell a put option to protect the NUA stock on the downside? Don't want to sell it in 1 year. Yeah, absolutely, you can. I mean, so a covered call option is there's no real downside protection. Let's stay with that example. Stock's trading at 100. I've got this covered call, but the stock just plummets. Well, certainly nobody's wanting to pay 110 for a stock that's, trading at 5, 10, 20, whatever the price is. There's no downside protection in that case. I mean, the stock does what it does, as if you'd held it anyway. And the question was around, what if you wanted to have some downside protection? And you can. There are different option strategies to be able to either say, hey, I want to sell it if it hits a certain price. Maybe you say, I'm willing for it to go down a little bit, but I don't want to see it go below 85, whatever it might be. You can set certain prices on that as well. So there's a lot of option strategies that you can use. So this is just going through the example here. So this is a covered call. So the premium, $3 per share. and the strike price, agreed upon price in this example is 120. We're going to do it on 1,000 shares. So the premium that this person would receive, so it's just 1,000 shares times the $3. So they get $3,000 deposited in their account that same day. So there's the premium that you made. And again, if it stays below, because the stock can go down, stay the same, go up, same as the market. So if it stays under 120, then it would expire worthless is the way. So you still kept your premium. There's no going back on that, right? You've got the 3,000, but nobody's going to want to pay a higher price than what it's trading. And then if it goes above it, it's very likely that the stock would get called from you. The person who bought it would say, great, if it goes up above 120, I'm going to buy it. So you would get 120 times your 1,000 shares. Doesn't matter where the stock's trading. If someone executes their covered call, then you're getting that agreed upon price and then reinvest the proceeds from that point. So yeah, this is just kind of going, as I mentioned, right? If you think about it, if it goes down, you've still got your premium. If it goes up, then it's going to get called away. The opportunity cost, because in this example, again, 120, that's the price you're selling it at. That's what you agreed upon. But you got that little extra premium as well. So the opportunity cost per share is about $2 because it's trading at 125. You agreed, you made a deal for 120. So you did get that premium, but there was still like a bit of an opportunity cost. The biggest advantage of selling covered calls is it gives you more income. Point blank. That's why people do it, really. There is some downside protection. Sure, if the stock goes to zero, you made $3 in premium, but not much. I don't know if I'd put that as a big advantage. Great strategy to divest shares. Absolutely. I mean, for a lot of people that I see that own company stock and their plan, most are pretty heavily concentrated in there, right? You love your company, you believe in them, you are investing in them every single day. So it's not uncommon to see a lot of concentration in one single stock. And we certainly want to minimize that risk. So great way to kind of divest of the shares. Capture upside profit, disadvantage. Again, they might get called, right? So you do need to be willing, kind of mentally, to say, all right, if I sell this covered call, am I okay that I would sell at that price if it executes? Downside protection limited to the premium received, as we talked about. We covered a lot. I'm going to actually go to the questions just before we wrap up to see if there's any that I didn't answer. This is a good one. Is there a time limit after retirement to move NUA shares from a 401k to a brokerage account? Yes, your RMD age. So if you retire at 55, you don't have to declare NUA until your required minimum distribution age, which is 75. And that's because taking a distribution from your 401k, from your savings plan, disallows NUA. So you can do it in that year, the first year of your RMD. You can still do NUA, but that's kind of the deadline, if you will. So you have, depending on when you retire, for most people, they have quite a bit of time to utilize NUA. And we do see that sometimes that when someone retires, they don't do it right away for a number of reasons. I've had a lot. I think I've done a number of these over the past few days for given where some stocks have been trading. But up until your RMD age is when NUA is still on the table for you. I think we covered a lot of the questions. So yeah, if you have other questions, reach out, and you work with myself or one of my peers here, one of the other wonderful advisors, certainly shoot a message over to your advisor. If you haven't talked with us before, we would love to talk to you and look at anything, any of your retirement planning needs or financial planning needs. Certainly reach out to us. We are happy to do a financial plan for you. We don't charge for a financial plan, so we like to demonstrate and show you any of our prospects what the experience would look like. So no signing on the dotted line to do it. If you want to just have us lay eyes on your financial plan and your situation, we're happy to help. Reach out to us. And yeah, thank you for joining. Everyone have a great day.